Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and their professional teams struggle to find great capital gains tax deferral options. Not having a clear plan is the enemy. Using a proven tax deferral strategy, such as the Deferred Sales Trust, is the best way to exit highly appreciated assets tax deferred so you can create, preserve, and grow your wealth. I'm your co-host, Pearson York, and we get awesome guests coming on this show all the time. And today we have a super special guest who's been in the financial advising, VC, and alternative investment space for the last 10 years, heavily in the tech sector. So we're going to talk tech sector right now, and we're going to talk market. We're going to talk alternative investments, tax strategies. It's going to be awesome. So please help me welcome in Drew Spaventa. How you doing, buddy?
Doing well, man. How are you?
I'm doing fantastic, man. It's good to get you on here.
Yeah, well, you're doing fantastic because you live in California, where the sun is shining. You got the beautiful beaches, and even though I'm in Long Island, I mean it's still New York. So, yeah, high taxes. Well, you know, you guys have high taxes.
We have high taxes too. That's the kicker, man. That's why I'm here. I'm solving problems out here for these high net worth people that are ditching us and leaving us to our own devices out here.
Leaving New York, leaving California to go to Texas and Tennessee's growing up now.
Yeah, it's
Florida, all these southern states. So
it's nuts. We'll have. I mean, to that point, right? Like, how is New York doing right now?
New York's fine. I mean, you know, you could definitely feel the difference pre-COVID, or should I say pre-pandemic, where all of a sudden there's an influx from people coming from the city to the suburbs because, you know, pre-2020, it took me about, 2 hours to get to the city at 8 o'clock in the morning. Now it's pushing like 3 hours sometimes. So you could definitely tell that the migration from people from the city to the suburbs definitely had an effect, even though there's been an outflux of people from New York going into states like Texas and Florida and everything like that. So logistically, it's become a little bit more of a nightmare. Aside from that, New York's New York, so that's it.
Yeah, the land of amazing pizza and apparently really good water.
Bagels, yeah, bagels. Gotta love the bagels.
Some bagels, right on.
So if you're a foodie, New York is definitely the place to be.
Yeah, absolutely. So you've been in the alternative investment space for quite some time, financial advising in the tech sector. Speak a little bit to that. How's the market doing out there with that whole situation, post pandemic, and just what's going on with you guys? High interest rate environment. Tell us a little bit about just kind of the macroeconomics of what's going on.
Yeah, I mean, on the financial planning side, being that we're obviously long-term holders, and I would say obviously it's more painful for people that are a little bit older, but at this point, we don't really pay attention to the short-term fluctuations and the volatility, at least on the wealth management financial planning side to a certain extent. But being that it's traditionally buy and hold and we're more conservative, these are just pain points that eventually wipe away. On the asset management front, where we do manage private investment vehicles, many of which are alternative investment type asset classes like venture capital and venture capital secondaries, the pain can be felt over the last 18 months. That said, I've kind of been beating this drum about, at least on the VC and equity side, about all these robust valuations over the last few years, where you had companies that were burning through cash, being valued at just insane multiples. Companies like, FTX is just one, and we all know how that came into effect. So it was a much needed reset on the VC front for everybody to kind of, investors at least, to wake up and say, oh, okay, we actually have to invest in companies that are being capital efficient. So, and that's the thing, going back into 2016, 17, 18, when I started getting really heavy in the VC secondary space, you could tell that valuations were lofty, but there was still, once companies had liquidity events and they went public, there was still a lot of meat left on the bone for our LPs to make a significant ROI. So you have two options: either sit on the sideline waiting for a so-called doomsday, or continue to put capital at work. So my strategy is to always put capital to work at no matter what. Always go into companies that we believe are going to be going concerns and be around for the long term. And in situations that we've seen over the last 12 to 18 months, if we could go in and buy more of the same company at a value because of the macroeconomic situation, that's something that we're going to take advantage of. So that's what we've really been doing. That being said, I think it's a really opportune time for some specific portfolio companies of ours to go in there and reinvest, especially because of the macroeconomic conditions. Moving forward, I think there's going to be more focus on companies that are being definitely capital efficient and not just hemorrhaging cash, which I think it should be the standard the entire time.
Right.
But, and as everything, you have everybody looking to bet on the bet. Generative AI has exploded over the last 6 to 8 months.
Yeah.
Because of ChatGPT and what OpenAI has been able to do. And prior to that, it was electric vehicles, right? Prior to that, it was cannabis and, crypto and blockchain. So there's always that hot trend. We don't like to really capitalize on hot trends. We like to focus on the specific company and really strategize from there. Because at the end of the day, you could put your money to play in the hot industry, the hot hand, so for lack of a better word. But as long as you're allocating your capital to the companies that you think are going to be, perform once they do go public and over the next 5, 10, 15, 20 years, you should, in theory, be in a good spot.
Yeah, absolutely. And so that kind of leads me to this question, right? So the strategy then, it sounds like, is to invest in these, basically, I don't know if they're startups or not, but you're coming in as a VC or an angel investor, right? Before, your Series A or whatever, maybe you're hitting the Series A or possibly Series B, whatever, right? You're infusing capital into these prior to going public, right? So is the strategy to really get them to go an IPO on the open market, and then at that point, right, everyone cashes out? Or how do you guys strategize for that?
Depends on what the stage is. I mean, if you're going in with an angel investment or Series A, the major thing that you're planning on is the company actually not going bankrupt because it's, as an angel investment, a Series A, there's really not that much of a track record to actually know whether the company is going to work it out. So it's cliche, but you're banking on the management team, right? So the further you get along in the stage, the life cycle as a company, once you get to that mid to later stage, the Series C, Series D, so on and so forth, which has been the stage that we've been focusing exclusively on for the past several years, then it becomes more about, all right, how's the company executing? What is going to be the exit strategy here? Where are they going to be over the next 2 to 5 years? Is the valuation that's being currently raised right now, how much of a valuation step up from round to round? Is it getting lofty? Once this thing does have a liquidity event and we anticipate it going IPO, and mind you, it's never guaranteed that it does go public,
Sure.
But let's just say it does, is there going to be enough retail demand, institutional demand for our LPs to make an investment? A return on their investment rather. So those are the things that we have to consider about. Because once you get to that mid to late stage, at least the company has somewhat of a track record. So it's a really beautiful balance of risk and reward where it's not as risky as a startup that has a Series A or is even pre-seed, but at least there could be some reward in theory, given that the company continues to execute in the private market before they decide, we're going to file that S1 and finally go public.
Yeah, definitely. So then at that point, right? So how are you guys handling the exits when you get those? Are you guys getting taxed on that? Tell me a little bit about your exit strategy.
Well, that's obviously the name of your show is Capital Gains Tax Solutions. So for accredited investors, the beauty, let's talk about the cons. The cons, at least for alternative investments, the bulk of them, especially what we do over here at TSG, are the illiquidity. Sometimes investors should expect to be at least without that cash for at least 5 years.
Right.
But the reward could be, exponential. So the bottom line, and then a pro to that too, is once you hit over that 12-month threshold, you're not getting taxed as ordinary income, which a lot of accreditors or, accredited investors are always looking to lower their tax bracket. You're being taxed as a capital gain. So 99% of the time, once there is an exit, our LPs are being taxed as a capital gain, not ordinary income. So that's definitely a benefit. Especially during a traditional IPO, which has been the bulk of our exits, minus SoFi. We actually had that went public via SPAC. So the lockup it went public, I think, in June, and we got access to our shares merely 2 weeks later. But typically when in a traditional IPO, even because you invested in the private market, because of those restrictions, you can't sell your shares for at least another 6 months. So that's why we also, we've had a few situations where one of our portfolio companies goes public. You have that first day pop. It's up, 2, 3, 400%. LPs are calling in, they're happy. And my whole approach is a little bit more sociopathic, where when things are well, you don't want to overreact, because it's also going to protect you when things don't go the way you want. You're also not going to overreact. So I don't really care what it does on the first day, the first month, or even the first week for that matter, because we do have to carry out that 6-month hump once those shares are truly unrestricted.
Gotcha. So it's a nice little like indication. Hey, this might do well. Like we're on the right path here, but hold your horses. Don't get too excited too quick, because until we get the ability to actually make the move, it doesn't actually matter.
Yeah, 100%. That's 100% accurate.
Cool. So when you have these liquidity events, right? I mean, since this is one of the cool strategies that we have is called the Deferred Sales Trust. Which what's unique about the Deferred Sales Trust is you can liquidate the asset. And it doesn't have to be real estate, unlike a 1031. It could be a stock, it could be a business, it could be real estate, primary home, it could be art, a racehorse. It doesn't matter. Anything that's highly appreciated. And what you can do is you can transfer the asset into an unrelated third-party trust in exchange for a promissory note. And then that asset is immediately sold when once the assets transferred into the trust, it's immediately sold, and then the trust is funded. And what's going on is in that trust, you're having a deferral state, and then that money you can direct to basically reinvest into whatever you want. So you can go back into it. So imagine you have a liquidity event, right, where you invested in the tech company, you put $100,000 in, right, it 10-20x or whatever, right, it's worth $2 million, and now you're at this point where it's like, okay, well, that's a $1.9 million gain. Well, instead of getting taxed at in California, it's going to be 37 to 40%, right? New York's probably similar, right? 40%, something like that, right? Instead of 40% of your gain going bye-bye, for taxes, you could actually take that and reinvest it. And so now you're playing with the full proceeds minus attorney fees instead of minus taxes. And so it's a fantastic way for you to continue to grow and develop your portfolio, right? Your wealth, accumulate it and preserve it, because through that note, you can do a whole bunch of different stuff. I mean, you can cash flow from it, you can reinvest it, you can put it into super conservative and stocks, bonds, treasury bills, or whatever, VCs. So as a financial advisor and as a alternative investment strategist, it's wonderful, because you get this ability now to all of a sudden, Johnny's got an extra, $500 million, $2 million, $4 million to play with that you would have had to shell out to Sleepy Joe over there. And so it's way better in your hands, right, than their hands. So it gives you a huge bump, that 40% bump in your AUM, that you can go ahead and reinvest those proceeds into other alternative investments and manage those funds. So it's a phenomenal strategy for that.
Right.
So there's our plug. Shameless.
Yeah, no, that's fine. I got it. You got to do what you got to do.
But you guys can find out more about that by going to capitalgainstaxsolutions.com. What are your thoughts on that?
Sounds interesting. Nothing that I ever looked into before. However, again, because of the nuances of my business and the regulatory scrutiny and how we operate, and we have to watch this and this and this, and because we have our hands in multiple different buckets. I mean, there's a few things that we could have done that we would prefer not to do, because they're definitely heavily scrutinized. So typically, once we do have that liquidity event, it's here are your shares, and it's up to you to decide what you want to do with them. So there's a few things. Now, mind you, those are for LPs that aren't clients of our financial planning arm.
sure.
We have certain LPs that just like to do business with us on the asset management side, and they just want to invest in our various investment funds. And we also have LPs that are also clients of our financial planning arm. And our financial planning arm, which is run by my president, I'm chairman of it. I have him run the whole financial planning aspect, and I focus more on the asset management aspect. That we do have different strategies to protect them from, tax repercussions and other things of that nature. And we do take that portfolio approach. So whenever we do bring on in a new investor, it becomes, okay, are they going to be an LP of one of our funds? Are they going to be a client of our financial planning arm? And then we cater to, number one, that type of relationship, and number two, the strategy that we're looking to utilize for that particular investment or that particular portfolio or that particular service. So it's definitely a lot more complex because we're not just, a secondary firm or a VC firm or a real estate firm or a financial planning firm.
Right.
We do have those several divisions that work under the umbrella of what is TSG.
Yeah. And that's a super important piece of it too, right? Because it takes more of a holistic view instead of a very, siloed view. And we've come across this, and as I think the internet and the ability to kind of like gather information quicker has, developed, and technology's kind of improved, I think people are kind of catching on to that, can learn more faster right now than you could. And the people that are in just, the insurance guys only want to sell insurance. The real estate guy only wants to sell real estate, right? The financial advisor only wants to sell mutual funds and stocks, right? Like that model is not going to work. You need a firm that has a holistic view of everything, right? How does A affect B, but not only that, but how does it affect C, D, and E? Because if you don't, right, you can catch yourself into a position where you're just like, crap, like I did it over here, but it screws me over here.
Well, sometimes it depends on the firm and the individual. Sometimes it's better to be a generalist, and sometimes it's better to focus on one thing exclusively. So in regards to financial advisors, yeah, we do have a financial advising component compared to other financial advisors, not excluding the wire. Well, I mean, you could even include the major wirehouses, the name brand companies that everybody knows. Most financial advisors don't want to take any type of risk whatsoever, right, because they don't want to lose out on that AUM, right? And my whole approach is, well, listen, it comes down to what type of client you have. If you have somebody that's incredibly risk averse, no, you don't want to take those type of risks. But if you have somebody that is an accredited investor, they have a certain portion where they do want to diversify their assets, especially with the 60-40 portfolio apparently having a midlife crisis here in 2023, where people are starting to realize there's all the other asset classes that you could allocate your portfolio to. Then you should be able to offer that to them. So within our financial planning arm, we're completely independent. We don't push our own internal insurance products, or we don't desire creating our own insurance products. We don't desire creating our own financial products to push them onto clients. Everything's completely independent. When it comes to our asset management and alternative fund side, those clients will have the option if they want to go into one of our funds. Some of them do, some of them don't, depending on their risk profile. And some of them, really want to, and we say, listen, you're not accredited, so we can't put you in. And some people, even if they are accredited, based on their liquidity situation or some of their other assets, you got to sit down and say, well, listen, perhaps in 6 to 12 months, once we rectify a few of these areas in your financial profile, then we could actually set that to some sort of risk by putting you into an alternative, such as, VC or secondaries, real estate, collectibles, whatever asset it happens to be.
Yeah, no, I agree with you. Like I said, there is a time and place for that. I think the overarching point, though, is that there's a model now that's coming in, and I think it's understanding how one affects the other, right? So that you can serve the client best, with that, if you have that risk averse client, right? Okay, hey, what are the things that we could do that are risk averse, right? And not just in one particular space, but in all of them. So it's good. So what is the Spaventa group really focusing on in 2023?
Well, we're continuing to grow our financial planning arm. We have a lot of LPs that have done business with us over the last 2 years. We launched the financial planning arm late last year. And we've just been incredibly busy, creating different portfolios for these LPs, showing them, explaining to them, retirement, estate planning, the whole nine, the complete wealth management ecosystem that we do offer. So obviously financial planning is going to be consistent every single year. As far as asset management and focusing on our secondaries, again, we're always putting capital to play or deploying capital, I should say, on the asset management front. And again, when it comes to VC secondaries, these private companies that are venture capital backed that we want to take a position in for all our investors / our LPs, we've switched from focusing on the innovative ones that we think are going to exit within the next 2 to 5 years to focusing on the companies that we feel that their valuations are depressed in the secondary market, that we could swoop up at what we believe are depressed valuations to where they should be valued at. And the second part of that is they have to be capital efficient. They have to be companies that are being efficient with their capital. They're not burning through a ton of cash. Either myself personally or through my professional network has access to some of these executives within these companies. So we do have conversations. I'm obviously not going to say certain specific companies or any specific conversations that we have, but that's really what we're focusing on for the foreseeable future. These companies that we feel that should be valued at A, but they've been depressed because of these macroeconomic conditions. And that could be a huge boon too, especially if you have a company that was valued here and they're valued lower because of these macroeconomic conditions. And then in addition to that, knowing the fact that a lot of these companies have slashed their workforce and they're focusing on bit profitability opposed to growth, when it does come time where some of these major names do make an announcement and saying, hey, listen, just file the S1, we're getting ready. Number one, what we're banking on is the appetite for IPOs will be substantial, being that it's been completely dead over the last 18 months.
Yeah.
And number two, these companies are in a hell of a lot better financial position than they were in the private market because they've made those cost-cutting measures and they're focusing on profitability, or at least being a hell of a lot more efficient with their capital, which should attract the likes of institutional investors saying, you know what, let's go into this company as soon as it goes public. So that's going to be our main focus for the next 6 to 12 months. And, just like the economy pivots at that point, we could go a little bit more risk on with some of the riskier names where maybe they're not at the level that they're being entirely capital efficient. Maybe that they're at a level where they still have to continuously raise money to focus on that top line growth. We just got to make sure that we're doing it smartly as each way possible.
So the main focus right now is finding companies that are managing their resources wisely. Correct. That are focusing on profitability, that are basically weathering through this economic storm, and who are basically just kind of hunkering down, grinding through, and getting out on the other side with at least some cash in reserves.
Yeah, 100%. I know that sounds pretty cliche, and that's something, but it's amazing how the simplest things people don't follow. And again, the last 7 years has owned up to the fact, because you've had so much money just being thrown at every single company, just willy-nilly. Here's a company, a hot idea, let's throw money at it, without any regard to, again, that capital efficiency. So what we're starting to see, because of the macroeconomic conditions and because of what the market is doing, the tide's turning towards these companies that are being a hell of a lot more efficient with their capital.
Are you guys worried about the banking crisis with like the SVB and some of these other First Republics, right, that are potentially, they might just be like, all right, they're going under?
No. I mean, we were clients of one of the banks, and because of our nature of our secondary business, many of our portfolio companies or our network partners and colleagues were also clients of several of these banks. So I've been into what's been going on. It's kind of conflicting whether, the government could come in and cover all deposits. But the broader concern, I mean, obviously, Signature Bank was taken over, First Republic, Silicon Valley Bank was taken over. It's been really exclusive to the regionals, but I don't see a systemic situation where it's going to, cause all these issues and have a ripple effect across the economy. I just don't see it.
Well, it was from what I understood, the regionals was where the tech, specifically like the tech sector, was getting most of their funding from.
That is
Yeah.
correct.
So how is the regional banks kind of struggling at this moment really affected your guys's kind of like risk tolerance for either A, holding cash in those banks, and B, if they're burning through liquidity so fast, we kind of touched on it already, right? They need to cut costs and hold that back. But if something were to go like that, right, like an SVB happens again where they're not necessarily bought out or whatever, some of these smaller regional banks, how does that kind of play into your guys's risk tolerance and factor into the whole risk profile?
Yeah, well, as far as our concern, we bank on multiple banks. I never got the whole put all your, all your
It's good.
cash in one bank. I didn't get that. So even though we were clients of one of those banks, and we did have exposure to a certain extent, it wasn't our entire business. If you would have asked me that question a month and a half ago, I would most definitely would have had a different answer. But at this point, I don't think I think it's a moot point, because any regional bank that posed a significant risk has been taken over. And at this point, any business out there that might have all their cash in a regional, they've already had their opportunity to seek elsewhere, or at least diversify their business into other banks. So if anybody out there has, some intelligence, which most of these people do, they're going to bank at multiple banks or take their capital away from the regionals that they think pose a significant risk, which we clearly saw even with PacWest, right? So we saw the outflows over the last 60 days. So people were taking their money out. But, we could also say that the whole reason for this was a combination of mismanagement from a couple of banks. Some of the banks, like Signature Bank, I don't think it was mismanagement. I just think it was the fact that they were taken over because the government posed their exposure to crypto as a significant risk. I think 20% of all their deposits were, or their loans were lent out to crypto-based businesses. So I think it's a combination by, stretching your muscles too much on banks management side, in tandem with the fact that we've had the most significant rate increases in nearly half a century, And again, it's easy for anybody that's not in Jerome Powell's shoes to say that, but let's call it what it is, based on what we've seen over the last few years. And yes, hindsight is 2020, but the bottom line is, after 2020, I get keeping everything at zero, but as soon as 2021 circled the corner and we could see a pickup in a lot of these asset classes and the economy, and everything starts opening up, albeit, in a small way, but they're still opening up, that's when you should have gradually started raising interest rates and not just shocking the economy. So, I hate to say it, but, that puts us in a situation that we have the second and third largest bank failures in history happening within a month of each other. So I think moving forward, the dust should settle, where I don't think that it poses any more systemic risk to this.
Yeah, that's interesting. That's good to hear. That's really interesting coming from the, a VC type, investor who's got exposure to that. Like, okay, like they did a good job basically managing that crisis, is what it sounds like you're saying. And the ones that needed to be taken over were taken over and they were dealt with. And
I
it
think,
sounds like,
I don't want to say they did the best job, but I do want to say, I guess it could have been worse. I'm not a fan of the government stepping in and backstopping to a certain extent, but given the alternative, at that point, it's the only thing that you could do. But we've really taken away the responsibility for a lot of these private companies to manage effectively by always having the government there to kind of act like mommy and daddy and protect you.
Yeah, and that's that's an altruistic point, because at that point, right now, you've just basically set precedents that these banks can do whatever the heck they want, and they know that they'll be bailed out if they're big enough, and it really kind of kills the whole capitalistic mindset. Like, hey, like if mistakes have consequences, right? And so, like, if you don't have the consequences. It's just going to keep making dumb mistakes, and it can hurt us in the long run. So I guess
Yeah, and another thing too is the $250,000 FDIC limit is a little bit on the outdated side. There's
right.
many businesses keep that amount of cash of working capital, a little bit more than $250,000. So I think that at least that amount should be raised, but there should be a little bit more scrutiny on what happens, with a lot of these banks.
Yeah, no, absolutely. It's interesting to hear for sure. So, all right, and then the last kind of question I want to just go over, and I know you got to get out of here, so I'll make it quick. But crypto space, where are you seeing crypto going? What's your thoughts on that?
I just had the committee hearing on before I hopped onto this, Pierce. So I was listening to the committee hearing that started at 9:30 this morning.
Yeah.
I was only half listening because obviously I'm doing work, and then I got in the background. I keep on saying it. Like, I don't think crypto is going away, but I think they need to figure out this regulatory situation, because the issue stems more from everybody that knows the technology or technological component and how it operates and how to effectively bring it to scale is on the private side. And it doesn't seem that anybody on government, could explain how it works or even knows it. There's what was it, a year ago, where I think Zuckerberg from Meta was being questioned at a hearing, and whoever was questioning him, thought he was from Alphabet. And I could have my companies mixed up, but the point is, one of the congressional congressmen or women thought Zuckerberg was representing a completely different company in a completely different industry. So this only goes to, and this is not to insult anybody, but this only goes to show you the lack of education and knowledge
Sure.
that many people in the Congress have about any specific technology. So to answer your question, and we do have one of our portfolio companies in the crypto space, and we have invested in Coinbase several years ago when it was still private. I'm still bullish on crypto. The big question is which ones are going to, survive. Obviously you have Bitcoin, and you have to know what you're getting in for, right? Ether, if you're investing in Ether, you're pretty much playing on the fact that this is looking to revolutionize the internet itself as a new blockchain, right? If you're betting on Bitcoin, you're looking at Bitcoin to be either a supplement or completely replace gold as a backup reserve currency. So I think it really comes down to educating people, but there's a significant hill to climb for anybody 40 and over when it comes to crypto, because the moment you actually have to sit down and explain something because it's so complex, the likelihood of somebody buying into it really diminishes it. When it comes to technology, you have to speak to somebody and explain it like they're 5 years old, because number one, the only way, if you would explain something to somebody like they're 5, it's going to be easier for them to understand. And if you explain it to them like you're 5, it's also going to show that you know what the hell you're talking about. Right. And when it comes to the nuances of blockchain and crypto, I've spoken to a lot of people. I haven't met a lot of people that explain it to me like I'm 5 years old. I know, so to a certain extent, how crypto works and blockchain and everything like that. And trust me when I tell you, I'm still weighing out the economic feasibility opposed to what people really want to believe in at their heart and hearts. The one thing I don't think is going to happen, and that's a major thing of crypto and blockchain itself, is the complete lack of some sort of centralized entity. I don't see it happening, because you're either what are you going to sacrifice? You're going to sacrifice conducting business through a centralized entity. If you do that, there's going to be no trust. Like, yeah, we could trade crypto and everything like that, but you might be a bad actor for all I know, right? But if you implement a centralized entity, now it could act as your hub of trust, where you know that as long as something's going through them, I wouldn't say guaranteed, but you could be that much confident that you're not going to be railroaded. And then on top of that, for the government to actually relinquish that type of power, or any of the major finance companies relinquishing that type of power, I don't really see it happening.
Yeah, and that
at least now. I'm not saying it's not, but over the next 5 years, I don't see it happening. We might get to a point, I don't know how old you are, I'm pushing 40, where in my 50s, we could start seeing it trickle. And I think that the way technology progresses, 100 years from now, we could be in a completely different society where I'm 100% wrong on everything I said, you're 100% wrong, and we're all 100% wrong. And we have no idea what the hell is in store over the next century. But speaking on the short term, I don't see any major progress, at least for the next few years.
Right. Though the one thing that I've been hearing kind of coming down is that the Fed coin wants to, the Fed wants to create their own currency, right, and then digitalize everything, and that's something that's, I think, is inevitable. Is they're going to try and create this, one world currency type of situation, and something like that. What's scary about it, though, is the fact that they, when they have that kind of control, they can control what you spend it on, how, when it's good for, they can pull it in and out. Like, it just gives them complete control over your ability to trade and barter and buy things, right? And it would control the entire thing. And so to me, that's scary. Like, the whole premise of crypto was, hey, get them out. It's decentralized, right? That's the dream, right? And the truthers are out there, right, that are pushing that vision. But I think you're right on the sense that it makes it really difficult for people to transact if you don't understand it, and it's just way too complicated, and it's unfortunately the centralized, the FTXs, right, and the Coinbases, they have a lot of power because they centralize things, but they create a super necessary thing, and that is the user interface to make it actually functional. It's so hard to pull out a nano ledger and be like, all right, let's trade this thing,
Yeah, and the another thing about crypto is, a lot of Bitcoin enthusiasts say, the government's printing way too much money and devaluing the dollar, which, yeah, I get it. I think that we printed way too much money and we spend money way too carelessly. However, there really is a pro because, for instance, if we didn't have the ability to print money and we were still on the gold standard, how would we navigated the whole, 2020 to 2022 situation? It's, printing money has had its advantages, 2008, 2000, obviously 2020.
Sure.
And the mechanisms of how our economy operated were pretty beautiful in the system put in place. So again, it's one of those things that what I don't like is when people speak so confidently like they know the answer, because none of us really do. Because again, there is a benefit to being able to print money to get us ourselves out of certain pickles. But there should be some decisions where we shouldn't even be in that situation as it is. If there was fiscal and monetary policy was actually that's the thing. So again, it's extremely nuances, and I'm not nuanced, and I'm not going to take a complete stance, a black and white stance, I should say.
Yeah.
I'm very middle grounded when it comes to crypto and blockchain and what my beliefs are and where I see things going. And I think there's the reason why I become a great, and I'm one of those rare people that I'm extremely disciplined and patient, and I take emotion out of everything that I do. I've seen my personal assets drop significantly during certain situations, and I never freak out or panic. It's just in my nature. And again, I like, my whole approach is to always be open-minded, no matter how crazy an idea might be. You always have to be open-minded, but you also have to be skeptical about human nature, about the incentives behind it, and really weigh out the risk rewards and strategize accordingly. That's the best. And that's the most boring answer. And that's the answer that people don't like hearing. Everybody wants to hear the rah, rah, rah. But the people with the most boring answers, your Warren Buffetts of the world, for instance, are the ones that are more successful. So, there's been plenty of times where, somebody might want to do business with somebody else because they're saying, oh, we're painting us such a rosy picture. And I'm saying, well, you got to be realistic. We could get there. You just got to strategize. That's why I think, strategy is the most important thing, because it's the one thing that you can control no matter what.
Yeah, no, that's super interesting. And I think that's super wise advice, right? Stay grounded, stay middle, instead of, going to either side of the extremes, because if you get off balanced, right, it can really derail you. So that's good. All right. Where can people find you?
TSGinvest.com.
TSGinvest.com.
That's it. Add our social media handles. We're on Instagram. We got content coming out. We're actually starting to bring up our marketing initiative. We're already associate partners with New York City Football Club, which is the Major League Soccer team out here. We also have a few other partnerships in the works where we're growing. So it's pretty exciting. So if anybody, follow us on social media. Our handles are all the same, TSG Invest. Go to our website, TSG Invest, and get ready some killer content over the next few months.
Awesome. That's super sweet. And if you guys are interested in learning more about the Deferred Sales Trust, you can go to capitalgainstaxsolutions.com. You can check us out there. We have a mastermind group every Friday at 10 a.m. Pacific, 1 p.m. Eastern. Sign up for that. We got content, YouTube channel, Capital Gains Tax Solutions YouTube channel. You can learn all about it. It's really awesome, amazing strategy. So, Drew, thanks so much for coming on, man. Any parting words? Any last final pieces of advice?
Yeah, don't feed Gizmo after midnight. No, it was if anybody's an '80s child, that's from Gremlins.
The little Gremlins.
Yeah. But man, I know we kind of went back and forth over the last few weeks, so it was finally be able to catch up with you. Other than that, just trust the strategy to everybody and don't believe in the hype too much. Don't get caught into it. Take a step back, woosah a little bit, and do your own due diligence, and you should be fine.
Yeah, that's awesome. Awesome. All right, guys. So if you want to check out Drew's stuff, tsginvest.com. Go learn about what you can invest in over there with the Spaventa group. They're absolutely crushing it. So hop on board. And again, capitalgainstaxsolutions.com. So thanks again, everybody, for listening to another episode. We really appreciate it. Again, not having a clear plan strategy is the enemy. Using proven tax deferral strategies, using proven investment strategies, right? Such as dollar cost averaging, not freaking out, level middle ground, non-emotional investing, deferred sales trusts are all fantastic ways to create, preserve, and grow your wealth. Please hit the like button, subscribe button, notification bell, share this thing all over the interwebs with all your friends. If you found value out of it, thank you guys so much. We'll catch you on the next one.